Hello, good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain, and for now the market is actually holding okay, and I'm saying okay because earlier in the day we had seen quite a bit of pressure. For now we are off the lowest point of the trading session, so we are around that 24,300 mark for the Nifty. The Bank Nifty is however coming under quite a bit of pressure, so that's seen a cut of almost 400 points throughout the trading session, and the broader markets are not doing any differently. There is that red on the screen across the board. Of course, it's autos which is taking the maximum amount of drubbing right now, and that's on account of the reverse gear that M&M has actually hit today. That entire price cut has actually put spanner at works, whether this is a sign of demand slowing down, whether it's the fact that their inventory is high in the system. All of those questions were being asked, but M&M has gone ahead and clarified to such reports that there is no build-up of inventory. Their bookings have been quite robust. This is only a celebratory offer, and overall this is a part of the plan that the company had built out in their annual estimates, and they're not expecting any major impact on the financials of the company. So that's a big clarification coming in. The street hasn't bought that as yet because that stock is down 7%. The other big pocket that we need to address right now is the paint stock. Let's pull up an Indigo Paints, up 9%. You also have Kanza and Nerolac with a gain of around 4%. You have Asian Paints which is up almost 3%, and Berger Paints will also come up for you on the screen. All of these paint stocks have seen quite a bit of spike in the last few minutes. Speculations quite rife in with respect to the overall price hikes that perhaps some of these companies that have been taken. So that's definitely something that we are watching out for, and all of these paint companies are reacting to that. Will be fairly interesting because we haven't seen a huge dip as far as the crude prices are concerned or the raw material is concerned, because actually in the last 1 month or so crude prices have gone up. Crude is now closer to $87 per barrel thereabouts. So a price cut coming in, a price hike actually coming in at this time means that the companies are quite confident. I'm talking about the paint stocks, so we should pull up those on the screen. The fact is that we have seen an uptick as far as the demand is concerned, despite the monsoon, despite the harsh summer, and that's the reason perhaps some of these stocks are doing fairly well. Take a look at Indigo Paints, up around 8% in the trading session. But what else is in focus right now? You have, of course, other names which are perking up in the trading session, and RVNL has had a stellar run of late. Today as well, that stock is holding with a gain of around 9%. Rajesh Exports is something that we are watching out for. Vardhaman Textiles too is doing quite well. You also have 5-Star Business, etc., which are holding up quite smartly in the trading session, while Blue Star is down, and of course, M&M is the big one to watch out for. And also the city gas distribution companies, the IGL, MGL, etc. of the world, they are in focus on account of the the reports coming in that there could be tax rationalization as far as CNG is concerned. But let me take the discussion forward and welcome Siddharth Khemka on board to talk to us about what's happening in the market right now. Siddharth, why don't we begin by the paint stock itself? They're definitely catching my attention on account of the spike that has suddenly come in. There is the expectation of a price hike. What does it tell you? Because there was part of the street that was worried that because of harsh summer, the construction and the overall real estate activity has slowed down. Monsoons, of course, have been a bit, all over the place as well. Is this an indication the demand is back for the paints sector?
Hi Anisha, good afternoon. So I think overall paints, the sector has been reeling under a slower volume growth, and that has impacted the sector, and on back of it, the costs have also gone up. So the overall view, I think, is not that encouraging. What we are expecting that for Asian Paints, which is the only paint stocks under our coverage, we are expecting or seeing a 12% volume growth in the domestic market for Q1. But despite that, the overall revenue is expected to be flat. So there is a lot of price cuts that they have taken in the recent past because of the increasing competition, and that is impacting both margins as well as the overall profitability. For the quarter, again, we are expecting a 10% decline in the net profits for Asian Paints. So that is not showing a good picture for the overall paints companies per se. Now, on back of this news of a price hike, we'll really have to see how much price hike these companies are able to take, and definitely that would be a positive for a sector that has not seen a very strong volume uptick in the recent past. If you see last two festive seasons, last year being a little better, but previous to that, things have not been that great. So again, as I said, overall view on the paint sector right now is neutral. There is an increasing competition. Raw material prices has been on a high, which is impacting your the margins. The only salvage that I can see is this news of price hikes in this entire environment, which could be a short-term trade for now.
Okay, a short-term trade, but definitely something that we are watching out for. In the meantime, Nuresh is also with us. Nuresh, your view on M&M, and should one be buying this dip that we are seeing?
So I would wait it out because this is the first time the stock has really seen a little bit of a correction or a swing low being broken. So the last swing low was around 2800, 2850. That's been taken out. And now in this case, the recovery could be a little tough. So out here, the ideal buying price is closer to 2600, 2650. So some more time to come before a risk reward entry point comes into the trade. So for now, it's a wait for a little more dip.
Point taken, wait for a bit more dip. But Siddharth, what's your view? I mean, it's a bit of a confusing factor. It was only a price cut taken on one particular variant, and that's for 4 months. The company is saying it's a celebratory offer just ahead of the festive season. There's no inventory build-up. The bookings have been strong, no impact on financials. Then why this 7% dip on the counter? What's the street parrot about? Is it the valuations which is leading to a correction?
Yeah, Anish, I think it's a mix of a lot of things. M&M has outperformed in the recent past, and the stock has done well, especially on the back of the good monsoon and the recovery in the rural demand. Given that tractors are the main segments for the company, the SUV segment for Mahindra continues to do well. Some of the newer launches, I think that has continued to do well. The street, I think, is concerned because we were not seeing any concerns with regards to demand for the SUV segment, and on back of it, the company has taken this price cut, which is a big cut for the street, and it was not built in by the analyst, and hence I think at this price level, there is definitely some profit booking that is coming up, but there is definitely a lot of questions that are arising. Why this kind of sharp cut in prices when the demand environment is pretty strong, and post monsoon we are expected to get into the festive season, and especially for some of the newer launches where things were just looking better.
Okay, point taken. So that's a view on M&M and paints, which are the two buzzing sectors right now. Quickly also wanted to mark what's happening to RVNL as well as, Vardhaman Textiles and Rajesh Exports for that matter. Nuresh, do you track either of these names, RVNL and Rajesh Exports? And RVNL, I mean, what a dream run it's been for the last 6 months, 1 month, whatever time period you select. And one is now getting very nervous. Should I take profit off the table? But the stock rallies again. What should one do with this stock?
So it's been a crazy ride for RVNL. So the last time it topped out in around 350, thought that the stock has topped out, corrected to 250 levels. And now we are back to almost 550, 600. The stock used to be $50 for a long time in 2021, 22. So out here, the risk reward is off. One would be better off looking at it as a case where you book profits and wait it out and avoid the whole sector as such. A lot of these railway names have gone to super high, say, moves in terms of parabolic nature. And when they top out, they'll correct 30% really fast. So unless one is ready to sell it 20, 30% lower, one is better off booking profits slowly and steadily in the current move right now.
So RVNL, yes, a crazy run. There's no better way to put that. But flashes at the bottom of your screen, because we do understand now that Berger Paints has also gone ahead and increased the prices. There are reports doing round that some of the other paints leader have also taken price hikes, and that's why the rest of the people have also followed suit. Berger Paints has confirmed to us that they have taken price increase in enamel, distemper, primer as well as putty. However, they have not taken any price hikes in emulsions and wood coatings. These price hikes are going to be effective from 22nd July. So this is the confirmation that we are getting. We are not very sure right now the quantum of the hike that has been taken. But what has been confirmed to us through our sources is the fact that there has been price hike taken. And clearly in the industry, that price hike trend has started, and that's something important to take note of. And you're having a rub-off impact across the sector, as I was talking about. Pull up an Indigo, a Kanza and Aerolac, an Akzo Nobel, even Asian Paints for that matter. All of these stocks are actually sitting at the highest points of the trading session right now. We'll keep tracking what's happening with this entire sector, and we'll get Abneesh also to join us very shortly to talk to us about the implications as well as the structural trends that are coming out for the paints industry, but only after this very short break.
it's a very proactive measure by regulator and also in this case by exchanges. In last couple of days, the regulator and both the exchanges in a sense are trying to really preempt and ensure that there is no systemic risk into the market, given that we've seen a deep swell and a very big I won't use the word froth, but a massive participation in the options market. In order to address regulatory issues and protect small investors from risk in index options, which in a sense has become very large in the last couple of years, especially after COVID, ET now has learned that SEBI has appointed an expert group on exchange-traded derivatives. And it has started discussions on multiple proposals, which includes increasing margin or lot size. My colleague Ankur Mishra joins in with the details.
Yes, market regulator is definitely in action for checking and taking a balanced view in FNO. Remember, there was a committee which was formed by market regulator to check what are the opinions regarding the recent surge in volumes in future and options, and now we understand that the panel, the working group, is likely to submit its recommendations to secondary market advisory committee, which is set to meet next week. Now what are these suggestions? We understand that one of the suggestions has been to increase the lot size as well as margins. Remember, in the past there has been decrease in margins as well as lot size, although these preemptive measures has been taken by SEBI in the past, but due to increase in prices of the stocks, many times you would have seen that the lot size have reduced. Now the suggestion has come that the lot size needs to be increased so that at least retail participation can be checked. Apart from that, you would have seen that SEBI has been in action in past 2 to 3 months. There has been several measures, and one of them has been the uniform charges which needs to be levied on MIIs, so that while on one hand MIIs charge customers on a daily basis, but they pay exchanges on monthly basis. So in between they were getting benefit in terms of increased volumes, concessions, which was not passed on to customers. In fact, it was a kind of a discount brokerage structure which was created. Now all in all, it will impact FNO volumes, and that concern has been voiced by the industry participants. Apart from that, we have
Ankur, I need to just interrupt you there. Sorry for that rude interruption, because Vinod Goyal in a sense is just holding on to the phone because he's got one step inside the board meeting and he still managed to talk to us. So Vinod bhai, good morning. Thank you for joining us.
Good morning. Good morning.
Good afternoon, sir. Sorry, good afternoon. Good afternoon. Morning show नहीं, afternoon show कर रहा हूँ. Okay.
Thank you for inviting me for this interaction.
Okay. Vinod bhai, there is a ramp increased in options activity. Everybody is looking to everybody for solution. Exchanges are saying SEBI should do something, SEBI is saying exchanges should do something, and me saying we cannot do anything. What is the best way out to protect the interest of a small investor stroke trader here? Because history has taught us that too much of speculation in the options market has always had a bad ending.
Yeah, but the term small is very vague, or it is loosely used as retail investor. Now, nowhere it is defined. If we take it as a corollary that it is opposite of the HNI. So if we take the IPO criteria, up to 5 lakh application is treated as retail. Similarly, for buyback, the quota reserved for the retail is those who are holding shares up to rupees 2 lakh on the record date. So otherwise, you see, retail in the common parlance is the persons who are trading in options on the last day, actually the expiry day. The concern is more arising from the heightened activity in the last 1 or half hour of the expiry day because of the this vast revenue potential, which may be lost to others as well as it may be gained to others. As you know, for every trade there is a counterparty. So in share market, there is a chance of losing money, there is a chance of gaining money, and every time NSE has a tagline, "Soch kar, samajh kar, nivesh kar." SEBI has a statutory warning. The stock investment in stock market are subject to markets. Mutual funds are also telling investment in mutual fund are subject to market risk, and now this 90%. So after that, if somebody takes an informed decision, it is up to him. But what for I was scheduled to talk to you is to the terms of this new circular, which is issued by the NSE clearing on 8th July, whereby the 1,000 plus shares have been taken out from the approved list to be available for as a collateral to the clearing corporation or the professional clearing member. I think this may be a fallout of that, because the so-called traders or the retailers, they were putting collateral with the broker, who in turn sent
Fair
it
point.
to the...
Fair point. I will also encourage Deepak Shenoy to join in the discussion. I'm coming back to you, Mr. Goel. Deepak, let's first address the headline. Indian options market currently are clocking volumes which are higher on days, which are higher than India's GDP. Option market has seen activity like never before. And we've seen historically, when the options market is dominated by a lot of retail activity, it ends up very badly. What is the best way out to protect the investor and also ensure that the market liquidity is not compromised?
So Nikunj, I think I would question the second part, that whether options market retail participation being very high has harmed the market, because we've always had a retail run market for the longest time, both in cash and the biggest traders in the market on an intraday basis are retail traders, not institutions. And even in options, that has been the case. There's a large amount of them. So I don't think there's necessarily a need to say that there are too many of them that are playing this market, and therefore we should stop it. But the bigger problem is that a lot of them lose money, and maybe they're undercapitalized to access some of these markets, which have extremely high forms of leverage. The reason it's higher than Indian GDP that you say is actually notional turnover, which is basically an option for which you may pay only 5,000 rupees. It is recorded as a 10 lakh rupee exposure. So it's a 200 time effective leverage on an option. That notional turnover looks very large, but the option premium itself is relatively small. A lot of option players are in that space, and I think we have the latest NSE Market Pulse has about 44% of volume in the options premium turnover alone is by players who have less than 1 lakh rupees per month, which is probably 5,000 rupees per day, which looks like relatively undercapitalized players that are playing this market. So in that context, increasing the lot size would probably make sure that there will be people who will have to put a little more money to play in, slightly more capitalized, because in an extreme leverage situation, you do require that people have capital in order to cover for extreme events. And that is unfortunately, something that the retail participant may not have. I think we should also account for systemic risk, because a larger number of undercapitalized players may create a systemic problem if there's a default. So that is another reason why you should kind of strengthen the market dynamics.
Shrikant Chauhan, one basic reason why the turnover looks strong is because of weekly expiry. You take weekly expiry and this whole arbitrage window out of picture, then suddenly the option numbers will look very different. Is there need now to perhaps roll back the whole idea of weekly expiry?
Yeah, good afternoon, Nikunj. I think there is no point in rolling out the weekly expiry which currently is going on, because this market requires speculation also, along with the overall normal activity which is there in the market. So most of the time what we see is that it actually strengthen the broader market, and that actually helps the market to do well in the long run. Yes, definitely, we need to increase, we can say, either lot size or we can increase the net worth of a particular trader. I think that criteria will help the market to reduce this type of speculation. But otherwise, I think that this particular market is like, it's something which is good for the long term. Yes, in the short term, and as Mr. Vinod said that yes, on the day of weekly expiry, on the expiration of that particular weekly expiry, we see substantial jump in the on the volume side. On that day, yes, definitely we can take some measures to control that particular activity. But otherwise, I think this particular system is going smooth.
Okay. Mr. Goel, other aspect is stock lending against individual securities. There seems to be an indication that the exchanges, they really want to perhaps review the definition. That is what, my colleague Ankur has also just flagged off. What are your thoughts on that?
No, that was not the lending. That is what we are discussing on the circular of July 8th, in which the clearing corporation has identified 1,000 plus stocks, which will not be accepted by the clearing corporation as collateral with a different degree, that not in one shot, but say from August 1, so much 40% of VAR, from September 1, 60% of VAR, from October 1, 80% of VAR, and from November 1, 100%. So what is happening, as we all discussed, the genesis of the loss was the leveraging, when these investors or traders, they put in the collateral with the broker, who in turn pledges it to the clearing PMC, professional clearing member, or they put to the clearing corporation. So what happens, ki there is no cash component, and what happens, just see, if I have share X and I give it as a margin, then again I am taking exposure against that. So that way, if that particular stock which I have given in the collateral, the price goes down on a particular day, or in the circumstances of the some happening geopolitical Indian, like anything. So if we take the case of, say, any company 1000 list, whose price is doing today 300 or 400, had gone down to below 30 rupees, 40 rupees in the COVID 2020 March. So that way they are concerned ki this is overloading the exposure. And the main criteria of identifying these stocks is that these only those shares which have been traded for at least 99% of days over the period of past 6 months will only qualify. Now you see, there are 5,000 plus companies listed on BSE or NSE also, and this futures is available only on 250. Stock future is available on 250, and under the new consideration of this eligibility for the stocks to be traded in fusion and option, there is another criteria, of which there is another circular and other meetings have been held, wherein also these points are there, ki at least the market cap of those only the shares which belong to the top 500 will be eligible and considered in terms of those where the trading is done. Now coming to the 99% of days, means suppose there are in a year 240 days of trading, after deducting 52 days of Sunday, 52 days of Saturday, and other statutory holidays. So in the 6 months, you will have 120 days. Now, if some stock is traded only and all of a sudden on one day, all of a sudden on another day, and that means liquidity is short. And suppose in the case the default occurs, or the margin is triggered, or stop loss is triggered, and that security has to be sold, then if there is no sufficient haircut, then there will be total loss. And accumulating all these shares of different traders or the brokers, there can be a huge risk.
Right, Mr. Goel. Mr. Goel, thank you very much. I once again want to thank you for just joining us. I know you have to step into a board meeting. So Deepak Shinoy, let's agree to disagree on few things. Would you agree with me that the options market activity is something where it needs supervision and no intervention?
Yes, I think we need to increase regulatory oversight, create a mechanism that the systemic risk is addressed, allow for such high leveraged traders to either bring in more capital to the table, either by a margin increase or by an increase in lot size.
Shrikant Chauhan, define supervision and not intervention.
Yeah, I also agree with you that yes, we need supervision. We need like to increase this particular uh, uh, in terms of like increasing margin or increasing lot size or introducing some more measures. But there is no point in discontinuing this weekly expiry schedule.
Well, Mr. Goel, Shrikant, Deepak Shenoy, thank you very much. I mean, what we're just trying to bring is some facts on the table that there is a huge surge in the F&O activity. Depending on the cut you look at, the volumes may look slightly different. But when markets are going through this extraordinary period of advantage of liquidity surge, money moving back from other asset classes to equity, digital platform, ease of trading, convenience, then automatically you will definitely see a surge in the options market. The red flag here is that options market historically has told us that 8 out of 10 trades or 9 out of 10 trades, at least when done by retail investors or by small ticket traders, they've not resulted in good profits. So what the exchanges are pretty much trying to do and the regulator is trying to say is the obvious, which is that understand your risk. Don't get carried away because of momentum. Know what you are doing, and there needs to be a little bit of hurdle change which needs to be done in order to ensure that this entire freewheeling move which is there in the option market, it really needs to be in the broader framework of risk management. That I think is what we just want to bring out in the scope of this entire discussion. Let's take a break, half an hour of market still left.
Back with closing trades right here on ET now. Let's just refresh our screens and take stock of how the market has panned out. It surely has been a rough ride for us. I mean, at one point in time, we were down over 200 points. Definitely seen a bit of a recovery from there. But is this sustainable? Don't know, because M&M is still down about nearly 7% on the futures. There's Tata Steel, Hindalco, Hero MotoCorp, TCS ahead of its numbers, slid about 2%. SBI is down nearly 2%. Tata Motors, L&T, Reliance. So the list of key heavyweights which are weighing heavy on the indexes, that really hasn't resurrected much. But Naresh, what is your sense on the kind of choppy ride that one has seen today, and whether or not the likes of L&T, or Reliance, or even M&M for that matter, can really see a rebound?
So the kind of crack we saw in terms of the speed in, say, a few minutes, we saw a crack of 100, 150 points happen. That's an indication that there is a lot of pressure on the higher end in terms of momentum not being able to take out that 24,400, 500 mark. So we could be getting into a consolidation phase. Now, the last swing low was around 24,100, 150 levels. Today also, we've made a low in that band. So that becomes a trading stop loss going forward. If that breaks, then we get into a short-term trend change. On the upside, 24,450 remains the resistance. So we could get into a 300-pointer band for the Nifty. Similarly, a 600, 500, 600-pointer band for the Bank Nifty. And stay here for some time. Only beyond these range, if we break, then we get a fresh trend. So for now, it's a time to wait and watch on the indices where the momentum comes going forward. We've seen a 2,000, 3,000 point rally on the Nifty from 4th June. So a consolidation would be normal. And if we break, then maybe we have to take a change of stance.
Point taken. Thanks, Naresh, for that. But in the meantime, let me welcome on board Abneesh Roy, the Executive Director, Nuvama Institutional Equities, to talk to us about the paint sector. Abneesh, hi, we've got individual confirmation from Berger Paints that they've taken a price hike effective July 22nd to the average tune of around 1.5%. They've taken it in enamel, distemper, primer and putty, while they have not taken any price hikes in emulsions and wood coatings. What's your channel check suggesting with the kind of price hikes that have happened from Asian Paints and the other players?
Yes, so this was a surprising move. We were not expecting price hike to start so early. Our sense was this will start a bit before the Diwali season. Now, this shows the strong pricing power of the paint industry, and we expect that also other paint companies like Indigo, Kansai, Exo, etc. will also follow suit very quickly. Asian and Berger have already taken the price hike, in most parts of their portfolio. Our sense is the reasons for these hikes are essentially they want to plow a bit more higher towards the advertising spend. So Birla Opus has entered, and during the current World Cup T20, we did see Birla Opus strongly advertising. So in light of that, we see the incumbents increasing the advertising spends a bit. Of course, they will also premiumize the portfolio, so there also the advertising spends will be needed. Second is the paint companies want their gross and EBITDA margins to be in a band. So although raw material scenario currently is not much of a concern, because crude has been range bound for a last few quarters, our sense is, of course, for any paint company, there is an inflation in the salary cost, there is inflation in the media and other costs. So to absorb that also, some kind of a hike was needed. Of course, on 17th of July, we will have the first Asian Paints coming out with the results, first paint company. Our sense is the results will be a bit muted because in Q1, essentially, because of the elections and because of the heat wave, the painter availability was a challenge. Plus, during elections, there is a model code of conduct. So the government new projects, etc., announcement is impacted because of that. Plus, the base margins for Asian Paints are very high, and that's why they have taken around 3-4% price cut in the earlier quarters. And now they have reversed this with a around 0.7% to 1% kind of a hike in most parts of the portfolio. So this is a good development. In our view, paint stocks are oversold because of Birla Opus entry. And from the Q2, we will see the volume recovery because the election-related impact, the heat wave impact won't be there. Plus, government's focus on housing for all, those things are also positive from longer term. So we expect for the full year double-digit volume growth for both Asian and Berger. So we are positive on both the names. But Asian Paints, we are more positive, and Berger is also good from a longer-term perspective.
Right. You know, Avnish, to the point that you were making that there was a price cut earlier, now there is a minuscule hike. Does it in any way indicate that there's further headroom for price hikes?
No, currently because raw material scenario is benign. Plus, if you see the current margins are also quite healthy. So it is not that they needed this hike, frankly speaking, but they do want to augment their advertising spend. So I would say the next round of hike will happen if crude and titanium dioxide moves up meaningfully. Currently, because of the global slowdown, we are seeing that both are in a tight range, not much of a concern. So as of now, I don't see price hikes in fresh price hikes. But how it works is paint companies don't take entire hike across the portfolio. So currently, for example, some parts of the portfolio they have not taken. Those can happen later also.
Okay, thanks Avnish for joining us for that quick take on the paints industry. So that's a surprise move that Avnish is talking about, a price hike that has been taken by Asian Paints as well as Berger as of now, and he expects the other incumbents to also follow suit. A good news coming in for the margins of these companies because it will allow them to fight the competition and maintain a healthy margin despite increasing their advertising and promotion costs. All of these stocks in focus. But Mr. Krishna Sangvi, the CIO Equity Mahindra Manulife MF is also joining us on the show. Hi, Mr. Sangvi. Good to be speaking with you. What's the overall market setup you believe right now? Because yes, this markets have run up quite a bit, and everybody's talking about that a correction is imminent, but one doesn't know when and one doesn't know why it will happen. Any guesswork there?
Yes, sure. Hi. Thanks for having us. And see, very broadly, let's look at market correction is obviously something which is a favorite discussion point, but we have to look at it more with A, economy, and B, in the sense that over the entire market cycle of last 5, 10, 15 years, we would have had enough of such instances where everybody's waiting for correction. But the reality, we have to track economy first, and I think economy is doing reasonably good. So to an extent, it's always going to be a replica play in the markets. Another part good right now for the market really is the flows supporting markets quite nicely. Flows across the segment, and so to that extent, little bit, if one is to worry right now, maybe one part can be the flows, which can really, create some sort of a slow moving market or some sort of, issue there. Otherwise, broadly, economy is looking good. We're on the right track for next, 3, 5, 7 years of journey. So for many investors who are looking to invest for this, longer term journey, perhaps, it's a right time to be there.
Okay, still a right time to invest if you have a long-term view and don't try and time the market for those corrections. But when incrementally should one should put money to work, Mr. Sanghvi? Because of course a lot of these PSU sectors, railways, defense look very frothy, and it's difficult to find value, or it's just difficult to put in money right now. Are there any sectors which look better on a risk-reward basis? Maybe an auto, maybe an FMCG or a pharma or something like that?
Yeah, sure. So I think if you look from a sector-wise, something which is, let's say, physical economy sectors like maybe, power, maybe commodities, maybe in energy, oil and gas, that looks interesting. From a broad India theme for next 3, 5 years, manufacturing remains possibly the, fulcrum for India's growth, because we are on this good path to achieve our own, Atmanirbhar by way of import substitution or generating our own export potential through PLI, etc. So I think that's the second part, manufacturing. And in a way, consumption, you're right, maybe FMCG, maybe, discretionary, because eventually, that's the end game for when India does well, nominal economy grows, per capita income grows, and by default, consumption picks up. So that's, the broad thought, maybe, on sectors. But yeah, in this entire journey, we always goes through, ups and downs because of valuations, at point looking slightly rich or slightly more favorable in multiple sectors.
But Krishna, soon we're going to have, earnings as well kick in. Of course, IT is going to be first of the lot to declare the numbers amidst the heavyweights, or large caps rather. But where is it that you see any scope, if at all, for an earnings surprise coming in?
Clearly, I think earnings surprise, can come in a little bit from the consumer side of the economy, because that's a space where we got a little bit rough patch in last maybe 12, 18 months space. That's on the consumer side. I think on the cap goods, etc., the order execution momentum is pretty strong, so they can really surprise, because that's a space where your order book is in place. However, maybe valuations can be partly factoring that a quicker execution cycle on maybe capital goods. So that's another space which can surprise the markets broadly in the near term.
Right, quite interesting. And what is part of the avoid list? Is it IT, or is there merit to believe that there could be a surprise there? Perhaps a change in commentary, if nothing else?
Yeah, clearly, I think change in commentary is something which can drive IT, far more in the absolute near term, because way one understands the global economy right now, more notably, the US and Europe. I think getting a big earnings surprise in the absolute near term may be a bit challenge. But again, if you focus slightly on a medium term, I think, that macro, outsourcing, how these companies have evolved over time, continues to remain favorable. So yes, IT can be little bit of a surprise more from the management commentary, because they are able to cite how they're dealing with the customers and the kind of visibility they're getting there.
And what's the view on manufacturing as a theme, and any specific budget expectations that you have, in the sense which could be good budget plays, a tactical idea, anything?
Yeah, honestly, manufacturing as a theme is so good, in a sense that we have a nice combination of a demography of 140 crore people who are possibly, able to consume a lot of things at a price point affordable to them. We have a nice market where, India is trying to achieve some sort of import substitution. So all the existing products already consumed by Indians can be made in India and under maybe PLI or under Atmanirbhar Bharat, depending on, the product category we say. And similarly, exports as an opportunity is there in manufacturing. So as a theme, I think manufacturing is good. Honestly, it's not really, a great idea to try and, anticipate something purely from next, budget, which might just be 10 days down the line. But yeah, the macro piece remains good, that, be more likely to be driven by manufacturing-led economic growth, maybe for next, again, 3, 5, 7 year period.
Just before I let you go, a question overall as to how difficult it is to kind of find ideas right now, because we're just getting those SIP data of yesterday, which was above the mark of 21,000, and a lot of fund managers have started complaining that at this valuation, it's difficult to still find good ideas. Is that something that you are also struggling with a bit, especially in the mid space?
Yeah, sure. I mean, what's clearly happening is that sometimes, the money flow from customer demand side or willingness to buy side is slightly higher than available opportunities. And that's where one ends up debating about, valuations being right or wrong, because, that pool of money needs to be invested in markets. And clearly there are some pockets where you believe that, the current stock prices are factoring maybe next 3 or 4 years of earnings, and to that extent, though fairly, richly valued. At the same time, if you look at broad market as an overall picture rather than only SMITs, I think large cap offers reasonable value across space. The earning growth there also can, be nice surprise vis-a-vis what we've been expecting over last maybe one. If you look at last 12 months, I think, a lot of news flow has been dominated by small caps have been done reasonably well on both maybe earning as well as multiple expansion. We believe now, large cap offers slightly better value for the near term, maybe now next 6 to 12 months period. And there are reasonable opportunities, especially, I mentioned physical economy space, which is, power, commodities, energy space, etc. Maybe manufacturing. And again, best part about manufacturing is that it's not really, related to pure capital goods. It actually can be across, can be automobiles, can be, consumer discretionary, can be pharma. So to that extent, manufacturing also offers some spot when one can invest. But clearly, yeah, at this juncture, with for the kind of money flow that's coming in, it's a little bit challenged to find something, is offering value.
Okay, great to have you on the show. Thank you so much for taking the time out and speaking with us today.
Thanks.
Okay, let's move on. Given the kind of fall that we are seeing in the market, and more so actually for the broader markets, the mid and the small caps, they've taken a far, worse slide today. While the Nifty, of course, is resurrected from the session lows, as has been the case for the mid and the small caps, but it's been quite a bit of gyration that one has seen. What are dealing rooms chatting about? What are the individual stocks that are propping on everyone's radar? Sharad is here with all that buzz.
Well, yes, in focus is Lux Industries, a Hosiery player from Eastern India. And also importantly, the dealer buzz is stating that HNI buying is coming across counters, especially in the second half of the trade today. The volumes have also significantly picked up, almost 8 times its 20-day average, and the stock itself has hit its intraday high levels of a 1-year basis. Now, interestingly, the buzz in the street is that a marquee investor's name might appear in June's shareholding pattern. So that is something which we'll be watching out for. Apart from this, also overall in the industry, if you look at it, the buzz is that Hosiery might be included in the textile PLI scheme, and 2 important factors going well for the company and as well as for the Hosiery industry as a whole. First is the cotton prices. They have been on a decline, roughly 10 to 11 month low, and that will aid the margins going ahead. And also the street is expecting that there would be inventory gains coming in the next couple of quarters. So 2-3 important levers are moving ahead for Lux Industries, and the dealer buzz is HNI buying is happening in this counter.
Okay, so that's the word coming in as far as some of these companies are concerned. Lux up almost 4% in the trading session. What else is buzzing apart from paints as well as M&M? India Cements is fairly active right now. 5% gain coming in there. And Brigade Enterprises is the other one. Actually coming back to the cement space, Prism Johnson is also doing quite well. Naresh, any view on some of these cement names?
So in cements, what we've seen is the follow-up has not been strong, but there are names which are shaping up well. So something like a JK Cement is interestingly poised for a possible breakout above that 4600 mark going forward. That has been tested a few times. Then there is a Dalmia Bharat, which is available at the lower end of the range, corrected good 20-25% from the top, has made a strong base around 1750, 1800. And could break out about the 1900, 1920 mark. So there are alternative choices on both the sides of the band on cements. So selectively positive on the stocks out here.
Interesting. That, of course, is the take coming in on Dalmia Bharat right now in terms of specific stocks. But M&M still in the red. SAIL, Hindustan Copper, MCX are all reeling under the heat right now. MGL, of course, continues to hold on to its gains. Asian Paints, like we said, is holding out well. India Cements holding up 3.5% higher. And REC and Manappuram are some of the other names which are also looking good. But Naresh, on that note, let's get some BTST trades from you as well.
So first would be a buy on LIC of India that is shaping up for a breakout. We've seen a good breakout happen across the whole insurance pack. LIC is again setting up for a breakout. So buy here with a stop loss at 1040, target price of 1100. Second is a buy on Manappuram Finance. The stock has come to almost a 3-4 year high breakout possible going forward. Stop loss at 210, target price of 220.
Right, okay, those are some BTST trades coming in. Naresh, the other thing I wanted to talk about is, I mean, autos, of course, is a weak link led by M&M aside, but sectorally, it's metals which are weighing heavy. What is it that you see on the charts for a Nifty metal, for instance?
So in the metal index, what we've seen is we've not seen strong follow-ups happen after the breakout. So we saw a new 52-week high happen for JSW Steel, but the follow-up was not great. Same is the case with the Jindal Steel, but we've not seen a similar crack also. So which tells you that we are still consolidating on the whole metal pack. Out there, you have a lot of stocks which are still showing a lot of strength, but there is no follow-up. So you have a Hindalco keeps going to 710 and comes back. You have a Nalco which keeps going to 200, 205 and pausing around that area. But the structure is still positive for a lot of stocks. My preference would be to look out for Hindalco and Nalco as structural bets going forward.
That's the view coming in as far as the overall sector is concerned, and what the view are about some of these companies as well. On the losing side, Blue Star is in focus. We also have RCF, which is down in the trading session, and Minda is also down. But let's also put the spotlight on the debutants on the street, and it's a very strong showing coming in from Emcure as well as Bansal Wires. Both of these companies saw gains of over 30% at start itself, and more importantly, they are holding on to these gains. In fact, Emcure is now up 36% as we speak. Here are the bites of the management interaction that we had earlier about the way forward for these companies.
Want to focus on reach and penetration and want to go to tier 2, tier 3 cities. In my opinion, that's the right strategy. Focus is on the big brands, becoming bigger. So volumes will also grow up. So obviously we require capacities that should get ramped up, in near future. So I'm very bullish about the capacities getting utilized in very near future. And that should also add to the margins. This acquisition we did in the month of October, and in the current financial year, I think it should add, at least 450 to 500 CR, to the top line and very healthy bottom line.
My margin per ton has been very constant, but in percentage, because of the fluctuation in our raw material pricing, it can vary a little bit. But on a per ton basis, it has been very consistent, and this is what we will aim for going ahead with higher volumes. So in fact, automotive and infrastructure, these have been our focus areas, and at least for the next 5 years, this is where we see a good potential and a good growth coming from. New products will help us tap into the infrastructure and automotive growth going.
That's a view coming in as far as some of these debutants are concerned. But the other story that we have been tracking from the budget point of view, and there have been quite a few as far as ET9 exclusives are concerned, but this was a fairly important one about the ramifications that could be there of the rationalization of tax on CNG. That's a consumer-centric story which is having an impact on the likes of IGL, MGL as well as Gujarat Gas today. We did speak with the management of GAIL as well as Mahanagar Gas to get the implications and the possibility of this particular report, and they say that they also see quite a bit of likelihood of the same. Listen in.
Currently, it is 14% in CNG, and if it comes down, the benefit will be passed on to the customer. Around 7-8 rupees benefit will be there in case excise comes down. Other prospect is that in case gas comes under GST, then also excise will be submerged in the taxation system. And then whatever is the differential benefit will be passed on to the consumer. As of now, we expect 10 to 12 rupees is the guidance for the margins. And the price hike happens because of input tax, what is the alternate fuel cost, what are our volume growth expectations, and so on and so forth. So there are several reasons on which we decide when to rise the price and to what extent.
The impact of this excise duty, even if it is made 50% from the current 14% to 7%, say, it will be about 4 rupees to 4 rupees 50 paise per kg, which is a big relief. If it is passed on to the consumer, it will be a big relief for the consumer. Gas comes into GST, the gas demand can easily double in next, I would not say 3 to 5 years, but in 7 years. We are normally talking about 2030-31 horizon. So we are sure if it goes into GST and the GST rates are mild, the demand of gas in the country should double.
Okay, and let's wind it up for the day. Let me hand it over to Vinny to walk us through the closing trades. Vinny?
So absolutely what we are looking at in the closing trade, Nifty will be closing with a cut of almost 0.5% that we are seeing today. Fallen from the day's highest point but recovered from the day's lowest point, so somewhere in between 24,320 levels is where the Nifty will be closing at. Sensex 2 will be closing with cuts of almost 0.5% at 79,920 levels is where the Sensex will be closing at. Advance decline ratio, like you can see clearly, in the favor of declines versus the advances today. And let's pull up what the broader markets did in trade today and where they are headed. Nifty Bank obviously is down 0.6 or 0.7%. Broader markets, slightly better in terms of the decline versus the benchmark indices, at least the mid cap, while small cap is down 0.8% in trade today. Nifty Auto, that's the major one that is seeing the sharpest decline today, down almost 2%. And in the Nifty Auto, obviously the top loser that we had today was M&M. At one point of time was down more than 7 to 8%. As of now, down 6.8%. So yes, closing the day almost at those lows for M&M. Clear pressure that continued for the stock through the day. Other than that, we also had Apollo Tyres that was not doing well. We had Exide, Motherson, Hero Motor, all of this surely putting in some bit of a pressure on the Nifty Auto side, and the pressure was building there. Other than that, metals, that was also not shining bright in trade today. So we did have all these metal stocks that were down. That was Hind Copper. We had SAIL, which was subdued in trade today, down more than 3%. Vedanta, NMDC, JSW Steel, all those pulled that up. They were all under pressure today. Pharma, that was a bright spot today coming in trade today. So we did have Zydus Life, did come in with some announcement right now just a short while ago. So Zydus Life is what we're keeping an eye out on. Mankind Pharma, there was a block deal that has happened, keeping an eye out on that one. DV's Lab as well as Glenmark Pharma also among the gainers that have come in from the Nifty Pharma side. Put up the paint stocks, right? Asian Paints, Berger Paints, we're keeping an eye out on that one as well. Asian Paints also among the top F&O gainers today. So Asian Paints holding on to gains of almost 3%, and that was leading to the recovery that actually came in for the Nifty FMCG today as well, is what we saw. A good recovery for Nifty FMCG from the day's lowest point was something that was supported by goods rich consumers as well, Britannia as well as Colgate Palmolive and Marico, which is managing to hold on to good gains. Let's pull up new listings. They did see good listings coming in from MCure as well as Bansal Wiring. New kids on the block, we'll be keeping an eye out on those ones going forward as that. And yes, that's how we'll be winding down the day. Nifty will be closing with cuts of 0.5%, similarly for the Sensex.